and welcome. You're watching The Money Show. I'm Kavita Thapliyal, and a very special segment and where we're talking about your tax-saving instrument and preparing you for the financial year end, which is 31st March. It's not far away. The deadline is fast approaching. You know, it's important for you to understand how can you minimize your tax liability and how can you actually figure out and finalize your tax deduction strategies. I have with me Arnav Pandya from Money and You School. And Arnav, today we'll be talking about everything that a salary class needs to understand. It's not only about submitting your declaration or investment declaration. It's about knowing your interest income. It's about figuring out your Reform 2S, your AIS and your bank accounts, you know, are on the same line. Looking at your mutual fund investment, your stock investments. So all that a salary class needs to prepare for, because you know it's a long weekend and we don't have much time in hand. We need to ensure that these processes and the step towards these processes are taken as soon as possible.
Definitely, that is the main thing which every salaried individual has to ensure. See, the first thing a salaried person has to know is that they should not miss out on any income. The reason for this is very simple, because the employer does most of the work with respect to the tax deduction at source. So in many cases, the salaried employee fails to tell the employer of any additional income which they have. Now, this additional income, either it is from a deposit or from, say, dividends from mutual fund or even capital gains, all these income have a tax element because these are taxable in nature. So the tax on these additional income has to be paid by the individual itself, and it could also have triggered an advance tax requirement earlier in the year. So if this tax is not paid, then the problem is that at the time of filing of the return, a big tax liability will arise. The second thing which also a lot of salaried people face is that they need to claim the deductions in a proper manner. This is especially true for those who have changed jobs in the year. Now, say if you have two jobs in the year wherein you have changed an employer, then the chances are that at both the employers you would have given an investment declaration and told them of all the investments that you made and the deductions that you have claimed if you are in the old tax regime. If that is the case, then if there are any deductions which you have claimed twice at both the employers' places, then this needs to be known at this point of time, because it means that you are actually claiming a benefit which is higher than what you have, and this will get knocked off at the time of the actual filing of return. So this is another factor which a salaried employee needs to take into consideration.
All right, you're talking about comparing your books of accounts and, you know, making sure that all of this tally, how important it is and how can one go about it?
So every salaried individual needs to know which are the various incomes that they have earned during the year. So this includes your savings bank interest, if any fixed deposit interest, any income from mutual funds, any capital gains. Now, the good part is that the income tax department now gives you the benefit of the AIS, wherein you can actually see all this information which is available with the income tax department, who has sourced it from all the different areas. So if you open the AIS details, you will find that everything right from the various incomes that you have earned, the tax deducted at source which has been made on it, or even the sale of various shares, mutual fund units, the value of all of this is reflected there. Now, this has to be seen with the figures that you as an individual have. Because if there is any discrepancy, then either it can be two things. One is that either you have missed out on some figure, which is a good thing, because now if you already know this, you can include this in your calculations. The other point is that it could also be a place where there is an error which has been made by the tax department. If this is the case, then the tax department also is encouraging you to ensure that this error is rectified. Because if, say, there is some income or some other detail which has been included under your PAN and attributed to you, but which is not actually your income, then you need to get this rectified. Otherwise, at the time of when you file your return and an assessment is made, at that point, this discrepancy might arise and the tax department might ask you to explain it. So errors which are there should be rectified. It's very easy to do so, and this will ensure that whatever details you have matches with the details with the tax department, so that the right income is calculated and the right taxes are.
Mhm. Can we also touch upon slightly on senior citizens and the kind of different forms that they need to look at, and the different way of declaring their income, because they have a lot of interest income also in hand. So how can they go about it?
So senior citizens, first of all, the question is whether the senior citizen is in the old tax system or the new tax system. If they are in the old tax system, they get an additional deduction in terms of a 50,000 deduction for the various interest income which they earn during the year. So this is an additional benefit which they get. If this is the case, then they need to see that what is the actual taxable income that they've derived during the year. The other part is that if their income is below the taxable limit, then had they submitted 15H earlier in the year for which there is no TDS. Because if there is TDS and there is no taxable income, then there is a need for the senior citizen to claim a refund. So for a senior citizen, the various heads of income, they need to add it up and see whether there is any tax liability which arises and whether there is a refund or not. So for a senior citizen now, if they're shifted to the new tax regime, the situation is easier because all that they need to do is check the AIS, see the income which they have, and then ensure that this is reflected when they file their returns and this is taken into their calculations.
Now, one very important question. What if you miss the 31st March deadline? What if you forget to, or you don't have the right kind of proofs to be submitted, or you miss the entire process? What's going to be the repercussion of that? Are we talking about some fine, or maybe you can look over it in a couple of months again?
No, so there are two things here. One is that if you have failed to meet the 31st March deadline for completing your various tax saving instruments if you are under the old tax regime, then the benefit will not be available. So there'll be a higher level of income on which you will have to pay taxes. The second is that if you actually made the investment but you don't have proofs of investment, that is not a problem at this stage because you just need these details at the time of filing of your tax return. And even at that point, you don't need to submit it, but you need to keep it so that if the income tax department later on asks for it, you are able to submit this. So the important point at this stage is just a few days before the end of the financial year is that any requirement with respect to investments or other things which you need to do for your tax purposes, you have to complete it. Because if this is not done, then the benefit is not available in the current year. A similar case is, say, something like a deduction for donation which is made to a charitable institution. If you want the benefit and if you are in the old tax system, you need to complete this before the end of the financial year. So that point is very important.
Okay. Now, assuming that one is doing all of this as per the old tax regime and they fail or they miss out the deadline, and they obviously don't get the benefits for being in the old tax regime now, but in the beginning of the new financial year, they change their income tax regime. They get into the new tax regime. Will that be okay, or will it be important for them because they have claimed in the earlier financial year that they are submitting everything or they are a part of old tax regime? You know, it's important for them to follow the entire procedure and then only take the benefit of the new tax regime. How does that work?
So, see, under the system, what you need to do is that every individual needs to compare their situation in terms of which regime is beneficial for them before deciding on which regime to go in. The other point that they also need to keep in mind is that for different uh, kinds of people, this kind of too much switching will not be possible. So, at the start of the financial year, it is very important for them to see what is beneficial for them in terms of their tax status. And that can only be done when they consider all these points which have arisen and then make their selection for the year because later on changes are very difficult to be made.
Sure.
So if you miss it for this year, then
Right.
I mean you need to look at the situation afresh next year.
All right. I think that will be all. Thank you so much for being a part of this segment today. Thank you so much, Arnav. Thank you.